Okay, in this video we're going to have a look at what the government can do if with a budget surplus and some of the benefits that can have for the economy. So basically, if we run a budget surplus, which is obviously the opposite to a deficit with more revenue than expenditure, they can do three things. They can invest the money in financial markets. Basically, that's just a fancy way of saying they've got accounts with the RBA. The RBA is like a central bank, and all they do is they put their money with the RBA. So they give the money to the RBA, and that they can use in the future for like a rainy day or when they really need the money. They're not giving the money to the general banks, so it doesn't have an impact on interest rates. So it won't lead to crowding in. So all you really know is one thing they can do with their money is they can put the money in financial markets, or they can give the money to the RBA. The second thing they can do is they can repay their existing debt. So it's kind of like the same as what you could do with your money. If you earn money, you could invest it in the bank, you could have savings. Second thing you could do is you could pay existing debt. So basically what that would do is they'd be giving the money to the banks and the financial institutions, so now the banks have got more money. The banks are getting money back, they've got cash, and that will increase their liquidity. And that can have the opposite effect on interest rates, which we'll talk about in a second. And thirdly, the thing they can do, and this is what they did generally in this period from sort of the year 2000 to 2007 when they were running budget surpluses, they can invest the money into a range of different funds. So Australia has set up different funds, including the Future Fund, and we talked about how they generate interest on that Future Fund. There's a Building Australia Fund, which is set up for infrastructure and building projects. There's an Education Investment Fund that's set up obviously to help improve education in the future. There's a Health and Hospitality Fund, or Hospitals Fund, sorry, designed mainly for our ageing population. There's also a disability fund. These are designed to provide money for future investment in infrastructure and these kind of things to support our future.
I think.
Okay, so when the government run budget surpluses, it has the opposite effect. It has this idea called crowding in. So when the government run budget surpluses, they become net lenders, and they will give funds or they will give cash or money to the private sector or private banks. That should lead to a reduction in interest rates because the banks have now got more liquidity, and therefore that puts less pressure on financial markets to raise their rates. So the decrease in interest rates will then boost consumption and investment spending and can have a positive effect on aggregate demand and real GDP. This is called crowding in of the private sector when lower interest rates help to attract demand and help to boost growth. Less reliance on capital inflow from overseas should also help keep the exchange rate low. So we don't have to borrow from overseas as much when we have a low and when we don't have a budget deficit. So that can again help to boost aggregate demand and crowd in the external sector because there's less capital inflow coming in as well. So when we run budget surpluses, it can have an expansionary effect through crowding in because governments become net lenders. There's less pressure for funds from overseas. This should help to reduce interest rates and the exchange rate, and therefore help to boost all these components of aggregate demand like consumption, investment and net exports. And overall that helps to boost real GDP and aggregate demand. So the advantages of budget surpluses are pretty much the opposite to the negatives of budget deficits. The government doesn't need to borrow, which helps to protect future generations because they might not get taxed more or less welfare, etc. It allows the government to save up money, so we've got money in a future economic crisis. It helps protect our AAA credit rating, so that should help keep interest down on our foreign loans, and the government's got more money for other investment projects like infrastructure and things like this. And it also helps promote international confidence in our markets when the Australian government's running surpluses, and that can help to promote foreign investment into Australia as well, which is really important for boosting our long-term growth as well. So summing up, this slide is really important. You get lots of questions about how surpluses and deficits can affect growth in both the short and the long term. And the key thing with deficits, running budget deficits in the short term is mainly expansionary. Okay, there's more injections relative to outlays. You can talk about what deficits may imply. So they may imply increased government spending, more infrastructure spending, more welfare, lower taxes. So they generally have an expansionary impact in the short term. Provide examples. But they can have some negative impact in the short term because of that crowding out effect, because of higher interest rates. In the long term, though, you're making reference to all those things we talked about in the last video. They can hurt our credit rating, which raises interest rates. There's more money dedicated towards interest, so less for other areas. The government may be forced to increase taxes and cut welfare going forward. In terms of surpluses, they have the opposite effect. In the short term, they can be quite contractionary. There's an increase in leakages relative to injections. The government may need to implement higher taxes to achieve this surplus, less government spending. But in the long term, they can lead to the government having more money available to fund growth. There's less money dedicated towards interest, so more can go towards education and infrastructure. The credit rating remains high, so we can borrow from overseas, and it promotes foreign investment into our country. Thank you.